Inflation rates look set to fall sharply with crude falling and the rupee rising and bond yields falling. There is a liquidity crunch in the system, and there is a political economy of demand that liquidity be increased, especially to specific sectors like NBFC and real estate. So how can policymakers, especially at the Reserve Bank, juggle policy instruments? Should they pull out that old instrument of cash reserve ratio, which they have not used for a long time? So I have still with me Sajjid Chinoy, the Chief India Economist at JPMorgan, and Kanti, Ghosh, Group Chief Economic Advisor at State Bank of India. B. Prasanna of ICICI also with us. Sajjid, you know, in the framework we now use is the Urjit Patel Committee report on monetary framework, where repo was the instrument for inflation control, and OMO was the instrument for liquidity. Is there no place for CRR at all? I mean, China is using it merrily. Why can't we experiment? Why should we not think out of the framework?
Latha, a few thoughts on this. First, let's understand what the scale of the issue is. I agree with Mr. Prasanna that, you know, currency in circulation has been very strong all year long. And the fact that the RBI has been selling dollars in the first 6 months of the year has meant that even if you make relatively conservative estimates on currency in circulation growth for the rest of the fiscal year, one needs to inject about 1.5 lakhs of durable liquidity into the system. Now, there are two parts to the RBI's liquidity framework. The minimalist part is to keep the weighted average call rate close to the repo rate, and that you can achieve even by doing term repos. We've seen that. The RBI has done 28-day repos, 56-day repos, and anchored the weighted average call rate to the repo rate.
Fair.
The second part to their framework is that durable outflows, which are currency in circulation and FX intervention, must be offset by durable inflows. Right? So the question is, what are these durable inflows? Around the world, central banks can only create base money in two ways, right? Net domestic assets through bond purchases, or net foreign assets. So let me say a couple of things. One is, in general, you want to spread the requirement across multiple instruments so you don't end up distorting prices too much. So what I would expect is, in the coming months, we will certainly see a lot of term repos, number one. I expect we will have to see a lot of OMOs, number two. Hopefully, because of the relief we've got from oil, our sense is the current account deficit in the second half of the year will be tracking closer to 2.2 or 2.3%, which then means we'll probably be in a BOP surplus, and the RBI will be intervening in the FX market and creating rupee liquidity. Now, to your question about CRR, 2 points. In theory, yes, that could be a fourth instrument and one that the RBI could deploy. The only difference, I would say, is not to get into this philosophical argument about whether it's a monetary instrument or a liquidity instrument. It does have monetary dimensions, because when you cut the CRR, you change the money multiplier. I will just say that the level of the CRR, when we entered the Lehman crisis, the CRR was at 9%. And if you remember, between October 2008 and January 2009, that was slashed from 9 to 5. There was a 400 basis point cut. So you want to keep enough gunpowder whereby, if, God forbid, there's a global crisis in the next year or two, and we need to, in a week, infuse a lot of liquidity into the banking system, you want to have enough space by having the CRR at a level which you can cut and slash dramatically. Even if we were to cut the CRR by 50 basis points today, that gives you 60,000 crore. It doesn't preclude you from having to do the other things, which are the open market operations and the term repos and possibly some FX intervention.
The multiplier works well for CRR, so even if you put in just 60,000 crores, one hopes that in 4 months it will be 1,20,000 crores. But thank you for that framework, Sajjid. Soumya, what would your thoughts be? You know, all through the 90s, Dr. Reddy would say that the end game of CRR should be 3%. And at that time, we used to work with, like Sajjid said, you know, high CRR percentages. Is not 3 a sufficient number? Why should it be 4? What is your complaint against that instrument? And, you know, each economy works on a different plane. China is using CRR. Not that it is the most cutting-edge economy, but, you know, in an emergency we can. Can't we?
No, I think before I talk about the CRR, the one point I would like to mention is that I think the RBI has actually managed the liquidity regime quite well, because they have a stated objective of moving the weighted average call rate to the policy rate. And given the fact that the durable liquidity, that means the currency in circulation and the liquidity taken out of because of the RBI forex intervention has been evenly matched by OMO and the term repo, and the autonomous factor government cash balances, if you actually look into the LAF operations and the government cash balances, they have almost matched each other. That means the autonomous factor also has been matched by the LAF interjections. Now, having said that, I think the use of CRR as a policy instrument in the modern financial system is extremely limited. It is just like in the words of the famous economist Mishkin, using a jackhammer to cut a diamond. And to be fair to RBI, it has been, they have clearly said that as an instrument of active money supply, it creates imbalances in the financial system and it should be only used under emergency circumstances. For example, after the demonetization, there was an CRR imposed. Then there was also an CRR imposed in 1990s when capital inflows used to come in. So I think it is now an instrument only used for emergency circumstances, and it actually needles the multiplier, and also it's not an effective instrument in controlling money supply. So whatever options that, and as Sajjid just said, a 50 basis point cut could only inject around 60,000 crores into the system and create imbalances. So to be fair, I think the instruments which the RBI is currently using are fine, and they should continue using it in terms of the active liquidity management.
Okay, gentlemen, out of time, but thank you very much for the lessons that you have left on the table. First, to address the immediate crisis, our money manager from ICICI believes that the Reserve Bank should not get into sectoral or any commercial decision of favoring one sector or another. Provide general liquidity and let banks take the call on whether and at what price they will give money to NBFCs or to real estate or to any other sector. A second important lesson coming from all the experts, and especially from the economists, is that CRR is a ham-handed instrument. And if at all we have to use it, it should be in times like a Lehman crisis when we may perhaps want to infuse unusual liquidity. It should not be used for an everyday problem. And the third big takeaway, the Reserve Bank is doing a fine job. It is using OMO and it is using long-term repos like, 56-day money and 28-day money that it is giving, which is ample. And it's clear that in what you call the CBLO market, there is a clear evidence that many banks have a lot of liquidity. And as Sajjid points out, that if crude were to stay where it is, we will actually have a BOP surplus. There will be an inflow of dollars. We saw some of it in November itself. And therefore, the Reserve Bank may be able to provide liquidity even by selling dollars. So, even by buying dollars. So, it looks like the Reserve Bank has got a thumbs up from all our experts on this panel. Thank you very much for joining this edition of Indianomics.